Hi, today's video is called A Lump in Your Throat. There's a reason for this. It's to do with one particular area of tax relief on pension payments. This area is an area that I've heard that many teachers who take additional pension, they're buying additional pension with a lump sum, they're not getting the correct tax relief. So let's have a quick recap on what is additional pension. It's a way of adding more to your pension now. So you can buy it in £250 blocks. You can buy 250, 500, 700. There are limits on how much you can buy in a year, but you buy them in 250 blocks, and you can pay for them in either a lump sum, which is the area I want to look at today, or in monthly payments. The blocks are index linked in exactly the same way as your pension is, so it will grow with inflation. You're buying £250 now. Hopefully when you come to take your pension when you're 65, 67, whichever age you are and whatever scheme you're in, it will buy the same things then as £250 will buy now. Crucially, it does qualify for tax relief. When you buy pension and your pension payments, you get full tax relief on it. So if you've been paying tax at 20%, you should get that 20% back in some shape or form. And this is the area where we're finding there's a problem. It only affects teachers who have bought or are going to buy their additional pension using the lump sum method. So if you bought your additional pension by paying monthly, this has not affected you. But if you have bought it with a lump sum, then you need to listen to the rest of my explanation and, of course, crucially, find out what you can do about it. First, a quick recap of how additional pension can be bought. And to do this, I'm going to look at the Teachers Pension website. Now, when you go to additional pension, you first of all set your date of birth, and I'm just going to go for the 1st of January 1970. The younger you are, the cheaper it is to buy the block of £250 because they've got your money for longer. And so you can, if you buy early, you'll get more. I do have a little bit of a thing about whether or not it's worth doing this or paying off your mortgage, and I'll do a different video on that at some point. You have to pick the pension age scheme for the age that you're currently in. They won't let you buy them for the others. So if I go for the career average at the moment, age of 67, I'm going to buy a block of 250. You can buy whole range of them. I said there are limits, but we'll stick to the 250. Dependent benefits, you can decide that the extra 250 will count for your dependent benefits. That's what will happen when you die. Will your partner, spouse get the half a pension? If that's the scheme, you're going to get half the pension. They will get half of this for their lifetime. And also, if you've got any dependents, any children under the age of 18, they will get a quarter to a maximum of 2 quarters. If you've got 2 children, get a quarter each. They will get that pension until they're 18 or leave 18 or leave education. And here's the crucial bit. We can choose to buy it as a lump sum, or we can opt for paying it over a number of years, paying monthly. And what I want to do here is to just show you what the differences are by opting for those two things. So first of all, if I go for the lump sum, okay, here we have the lump sum, and you can see down here it's costing us £3,110. Keep that figure in mind. I will come back to that in a second. Let's go back now and have a look and see what happens if we change it to, instead of it being a lump sum, going to buy it for a year. And so we're going to pay that amount of money over 12 months. And it's going to come out of our salary, out of our wage packet. Now, this time, the total amount being paid is £3,184.80. Now that's slightly more, isn't it? Let's just flick back to the presentation and have a look and see what that means. It costs a bit more, roughly £75 more. And all that is really just enough to cover the extra processing costs of taking 12 payments instead of just the one lump sum payment. Plus, of course, the government is missing out on the interest of the £3,000 that you would have paid them at the beginning of the year when you pay it bit by bit over the year. Exactly the same way as overpaying can save you on a mortgage. But the key point to take away from this is that it's only £75 different. at this point, the amount of money they're going to charge you. So how does this show that we could be missing out on some important tax relief? The key thing is that pension payments are taken out of your wage packet before income tax is worked out. When you pay monthly, the payment is taken directly from your wages, so in that case you have had the tax relief. You didn't pay any tax on that £3,185. It was never even considered for tax. So here we have our salary of 40,000. We pay our normal pension payments of 4,000, and then this £3,185 over the years divided up in 12, but I'm going to do it as a whole year so we can pair the two together. So they've taken out the pension payments of 3,185, and your pay packet then becomes 32,815. That's your taxable income, how much the government will look at and say, you owe us 20% of that. Compare that to the lump sum method. Now in the lump sum method, we take off our normal pension payments, but there's no additional pension. When you buy the additional pension with a lump sum, you're writing out a cheque or you're doing a bank transfer from money that you've already earned and has been paid to you, and crucially has been taxed. That tax is £637. So you're paying a lot more tax by buying it with a lump sum than you are if you're paying it monthly. So there's the crucial, that's the first thing that should give you the confidence that what I'm talking about is correct. So let's have a look now at what are the main obstacles to getting that money back. Now I did say obstacles, and to be fair, it isn't the tax authorities that are the biggest obstacle, it's what they have to deal with that's the problem. Firstly, the TPS is not a normal scheme, and by that I mean it isn't the most common scheme. They get thousands of calls each day, and there's probably not even 1 in 1,000 are related to schemes like the Teachers' Pension Scheme. So it's worth first getting to understand why the person you're talking to at HMRC probably doesn't get immediately what it is that you're talking about, and you've got to persevere a little bit to help them understand what you're after. Teachers' pensions normally come out of their pay packet before tax is worked out. Do you remember from the previous slide that we had that on the right hand side? They take the money away from you and then they work out what your taxable income is. So even higher rate tax is taken care of. This is called the net pay method. So as soon as you start talking to HMRC, their first instinct is that you've already had full relief. As a teacher, any payments you pay from your salary are the net pay method, and it takes care of all your tax relief needs. The second problem is that the vast majority of pension schemes have been set up to do something called relief at source. This is where the company running the scheme take your money after you've paid the income tax and then get the government to give them the 20% that was the tax that was taken off you. That's the vast majority of what are called defined contribution schemes. And the problem with those schemes that can confuse HMRC when you're talking to them is that they only pay back the 20% tax rate. So in their case, if you're a higher tax rate payer, you have to phone and contact HMRC to get the other 20%, because you paid 40%, you have to get that other 20% additionally paid back to you directly. So these are the obstacles, because 99.9% of the calls HMRC receive about pension tax relief are from people who have already received the tax relief or who want to claim the additional tax relief. So these are the obstacles. Firstly, the call centres have to deal with people who have already had the relief, either through not paying it in the first place or by having their pension scheme provider claiming it back for them. In most of these cases, what is happening is invisible to the person who is calling them. And quite often the tax people are dealing with people and they're trying to explain to them, you've already had the tax relief. They think you are mistaken. Don't be convinced by them if you have paid by lump sum. Secondly, the other obstacle is that the person on the end of the phone, when they do find that there's somebody they do have to process, it tends to be those people who have got to contact them to get that additional relief, that higher tax rate of relief. And that can easily lead to confusion, because unfortunately the additional tax at 40% is an extra 20%. And because you're talking about the basic rate also being 20%, they can get very confused about which 20% you're talking about. So don't get sidetracked into that. It is not additional relief that you need to claim, though if you're a higher tax rate payer, you'll need to do that as well. What you're wanting is the basic tax relief at the lowest level, because your system is not set up for automatic tax relief. So the solution, first of all, is to give them a call and see if they can do it with you over the phone, or if you're going to have to fill in a tax return. Be clear to them that the scheme you are paying the lump sum to is not set up for automatic tax relief. If they try to explain to you and lead you down the arguments of the net pay or additional relief, just help them out by telling them that both those features of the schemes are those that are set up for automatic tax relief, and that the teacher's pension's lump sum purchase of additional pension is not set up for automatic tax relief. This is the key phrase. The HMRC website does say that if your scheme is not set up for automatic tax relief, you're going to have to claim it directly from HMRC. Be prepared to persevere. Have the confidence you are right and that you should get the tax back that is rightly yours. I hope I've managed to explain this clearly and have given you enough of an understanding of how the tax system works to let you get the tax relief back if you deserve it. I've finished with this as the reminder. Both of these methods bought the same amount of pension, but the lump sum method was bought with money that has already been taxed, whereas the monthly method is bought with money that will never be taxed. That clearly cannot be right. You can't buy the same amount of pension and paying for it monthly cost you $2,500, and if you pay it in one lump sum at the very beginning, it costs you nearly £600 more. That's the tax relief that you need to get back. So do persevere. Do get the tax refund if you're owed it.